Okay, good. Again, so we're calling the meeting to order. And the first item, or the second item, is board organization. So with Mayor Thomas leaving the board and Mayor Pro Tem Hernandez joining the board, we need to name a new vice chair. So opening it up to nominations for vice chair.
Seeing as I'm replacing Mayor Thomas, who was the previous vice chair, I'd be more than willing to nominate myself unless anybody else has their heart set on fulfilling that responsibility.
I think that's a great idea.
Okay, I'll take that as a motion and support. Any other nominations? We will close them then. All in favor of Pro Tem Fernandez being the vice chair, say aye.
Aye.
All opposed, motion carries. All right. Moving on, we have the minutes approval from the last board meeting on November 10th. Thank you. And we're looking for a motion to approve the minutes when the board's comfortable doing that.
I'd be happy to make a motion to approve the minutes as presented.
By Emily, supported by Michael. Any comments? All in favor, say aye. All
Aye.
opposed, motion carries. Okay, moving on to item or to reports. And Florence, the SCI investment report starts on page 12 of our PDF packet.
Yes, good afternoon, everyone. So I'll be using this big packet, so I'm going to page numbers. So let's go to page 14. And that's the working agenda, not set in stone. And as always, at the beginning of the year, I like focusing on this page to invite your contributions. So if there are any special topics that you think would be of interest, please let me know. Or then pass on the message. And for today's meeting, we're gonna cover a portfolio review, an economy and market update, as well as a portfolio stress test based on a dollar decline. And that second topic was your contribution. So thank you. This is exactly what I'm looking for when I'm talking about contribution of ideas. I have education TBD for May 11th and November 9th. So if anything comes up, please let me know. So we'll then move on to slide 4. Cover the summary of the portfolio results. 2025, a very good year for the portfolio, a net of fee return of 16.5%. And the funded status at 98.9%. So very good, supported by strong markets, diversification, and skilled active investment management with your fixed income assets. So what we saw within equities, the AI theme was a key driver of performance, and it was broad across regions as well as across sectors. We also saw a weakness of the dollar in 2025, and that helped contribute to the better performance you're seeing with the non-US assets, both in equities and fixed income. So then alternatives, you do have private equities, GPS 6-7 and the Secondary Opportunities Fund, both on a net of or on an aggregate very strong internal rate of return, I would say, given the private equity environment that we're just coming out of at 9.4%, and also where interest rates stand. And I'll speak more to that when we get to a slide that focuses on the performance of private equities. Any questions on the summary? All right, so slide 18. So that's the broad market performance and across different segments of the markets. And as you can see, the darker blue or black is the 1 year, and then the bright blue there is the Q4. So when you look at the top part, the first four, those are your equities, the equity market, and emerging markets equity was the best performing market, followed by the developed non-US equity as represented by that World Equity ex-US proxy there. Then the next few rows at the bottom of next 4 rows, that's the fixed income market. Strong performance also came out of the emerging markets debt market there. And then we also saw a very good performance, I'd say strong for commodities driven by precious metals, as you might have had, gold and silver at historic highs. I mean, we had some pullback the last couple of weeks, but that was the key driver of the commodities sector. Then the next slides, what I did here is include a couple of slides on key economic data, just to provide a historical perspective on what's in the headlines. So if you look at slide 19, that's CPI, that's inflation measured by CPI. And we are looking at inflation in that chart to your right, we are looking at inflation across emerging economies and advanced economies. As you can see, for both economies, we have meaningfully dropped from the significant highs in mid-2022. And when you look at the emerging economies, it continues to trend lower. However, for the advanced economies, that's ticking higher and above the 2% policy rate. Both are still above 2% policy rate, but a little worrisome that we are trending higher in the advanced economies. Our outlook is for inflation to range between 2.75 and 3.75. We maintain a stance that inflation is going to be higher for longer, slightly different from consensus, but that is really our position. When we mean higher for longer, really just above that 2% policy rate. The next key data is unemployment, slide 20. And the chart there is plotting unemployment rates across developed economies, Canada, UK, the Eurozone, and the US. What's notable or significant with this chart is comparing the unemployment rate today around maybe 4.4% to the 2010s. And during that time, it averaged at about 5.7%. While the job market is cooling and we're seeing slow hiring and firing, when you're looking at the unemployment rate, not as bad as the 2010s, but still something a concern and something that is a focus of the Fed Reserve. Slide 21. I included this slide just to address what has been a very key headline regarding the K-shaped economy, where you've got the lower income perhaps feeling more pain than the higher earners. However, when you look at this chart, and it's from this is a University of Michigan Consumer Confidence by income across middle third, upper third, and lower third, you can see that everybody's feeling the pain and it's trending lower. But the significance of this chart is that when you go back to the global financial crisis in 2008 and 2009, we are below, the consumer confidence level is below that. So significant, but an interesting data point that we've shown in the past is that when you look at consumer spending data, we continue to see the consumer spending and of course driving the economy. So despite the survey showing negative confidence, the spending numbers do show something different. Slide 22 summarizes our economic outlook. I've touched on a few, the key important one. We've got a few others with the first one being the US economy. So we expect our outlook for the US economy is strong when amongst developed economies. When it comes to corporate earnings, we had very strong year in 2025 with corporate earnings. We expect, we have a positive outlook for growth in 2026, and not just in the US, but also outside the US. We do like valuations outside the US and do find valuations very expensive, particularly for large cap stocks in the US. When it comes to geopolitics, that remains a topic, but from a market impact perspective, we expect that to be subdued in 2026. Any questions? So slide 23 is a summary of our key or our strategic investment views, and not maybe just a couple of changes from maybe what you've seen in the prior quarters. When it comes to equities, the addition there would be that, we now have a much more favorable view of emerging markets equities, as well as in fixed income from a currency perspective. What remains standard is really our exposures across the key factors that base our investment process: value, quality, and momentum, with a preference for value. Within fixed income, we are defensive and continue to like securitized over corporates, and also are positioned for the yield curve to continue steepening. Any questions? All right. Slide 25, good slide here, just to visually see the trend of your funded status during the half part of 2025. Again, a very strong one at 98.9, and I'm sure he's gonna go through that, provide better support to that number, but a very strong number. Slide 27, net change in market value, and during the year, actually a good way to really think about performance from a cash perspective. So 1 year, that last column, the portfolio, the draws on the portfolio net cash outflows was about 3.2 million. That includes benefit payments, it includes management fees, and if there are any contributions, those would be netted here. However, the significant number here is the 13 million. That's investment income and gains that the portfolio saw in 2025. So you started the year with 80.2 million and ended the year with almost 90 million in market value. So the next couple of slides, starting with slide 28, I'll go into the details of performance. Your first row is the gross returns, and I'll focus on the 1 year column. The second row is net of fees, and then the portfolio index. So, and then there's these other benchmark here, 60% of all country world equity index, and the 40% Bloomberg Barclays Global Aggregate Index. So as you can see, you are outperforming on a gross and net of fee basis, the portfolio index, and just lagging these last benchmark here. Key drivers of performance equities, like I said, and diversification playing a significant role. You look at your US equities, you have good diversification in line with our strategic investment views. You have the US Equity Factor Allocation Fund. That fund represents approximately 98% of US equities. And the role that it's playing is really diversifying the mega cap technology concentration that we are seeing in the S&P 500. That fund, the US Equity Factor Allocation Fund, is across large cap, small cap, and mid cap. So you are getting exposure across market caps, but you do also have additional exposures for the SMID equities, as well as the extended market index fund, the smaller cap part of the markets. So the World ex-US is your international diversifier, a strong absolute return of 29.6%. And again, benefiting from the weakness of the dollar. The lag that you are seeing relative to the benchmark really is because of our style. So quality did not struggled, in 2025, and not just for this fund, but just more broadly for the market. What really did well was value and momentum. And as an example, to contextualize these, what we saw in the international markets was sectors like banks and materials, specifically miners, doing very well. We are underweight that. We are also underweight technology, and semiconductors outside the US did very well. And sectors that we are overweight and have that quality exposure, like healthcare, in particular pharmaceuticals and consumer sectors, did contribute to that pullback, but nonetheless a very strong absolute return of 29.6%, and with your almost 22% allocation, very decent contribution to the total portfolio return. So diversification paid off. You also have additional diversification in the next slide with your global managed volatility fund delivering a strong 18.2% return. Fixed income, total fixed income, 8.4%. Very good return for fixed income given the characteristics of the asset class. And what really separated managers here, given that what we are seeing is very, very tight spreads compared to history. What separated managers was really the skill in the way they actively managed. And for us, I'd say when you're looking at core fixed income, that 7.6 return outperforming the benchmark, a very good one when you even compare us to peers. What really helped was our overweight and focus on the yield curve, particularly the 2 to 5 parts of the curve. We were also overweight agency mortgage-backed securities in line with that securitized theme we have for fixed income. Agency mortgage-backed securities was the best performing sector, and we were overweight financials, also a very good, the best performing industry within corporates. Then the diversification with your emerging markets debt and high yield, those were also additive. As you can see, emerging markets debt did return 21%. Total alternatives and primarily your private equities, strong return of 12.7%. I'll speak more to that on a different slide. But you also have dynamic asset allocation fund, that last category there that says other. Very strong return, outperforming the S&P 500. Its benchmark is the S&P 500. So it returned 20%. So this fund is one where we implement our active views, and we are positioned with these themes around. We have global debt dynamics. We have a theme around monetary policies, stickier inflation, and we also have hedges. And it was the yield curve steepeners around that global debt dynamics, as well as the gold hedges that we had, that really contributed a lot to that 1 year performance and outperformance relative to the benchmark. So the next few slides are really calendar year performance, so I'll skip those and I will try to go to the slide 32. So these are private assets, a better way to look at the return of private equities, looking at the internal rate of return, 9.4%. So your vintages are very recent, still in the early investment cycle, but I'd say strong returns given the private equity market, about 54% funded. When you're looking at that number in aggregate, you have about a 5.7 million commitment. Your GPA 7 being the most recent commitment. As you can see, there has been some capital called on that, and that particular fund, we're still investing and hope to be fully invested by mid this year. Some positive early returns, given that you're very early in the cycle, and some of those good returns are coming out of our core investments. And as an example, one of them is with Lightspeed Ventures and their investment in Anthropic. You've probably heard about Anthropic in the AI field. So again, good returns for that fund this early in the cycle. So what we are seeing in the private equity market, we're starting to see improvements with deal activity. 2020, we started seeing that in 2025. As you might know, the higher interest rates did impact, relatively speaking, did impact the market. So we're starting to see an improvement with deal activity, some improvements with exit, opening up of the IPO market. Where we are continuing to see a struggle is with fundraising because of liquidity. But overall, good diversifier of risk and return enhancer for the portfolio. Slide 34, these are manager changes in the last quarter. We usually provide these quarterly, so what we provided here was just for the last quarter. So we did have a change with the high yield bond fund where we terminated T. Rowe, and that was because of just a drift in style expectation from what they were hired to do or contribute to the fund, and we did add Blackstone liking their securities selection process. Then World ex-US, we terminated Nomura for portfolio construction reasons. They were low volatility, and we no longer have a higher conviction for low volatility in that particular fund. Any questions? Right?
Nope.
Good. Okay. Slide 35. So there was a question for us to talk about the dollar strength and interest rates. Like I mentioned, in 2025, we did see a meaningful decline of the US dollar. The US dollar peaked in Feb of 2025 and declined almost 10 to 11% by the end of the year. So there are a few, so on slide 36, we do point out maybe a few scenarios where when you have a dollar decline, the kind of impact that you'd see with assets. So in a growth driven and global easing environment where the dollar is weakening because of global growth improves and US real rates are falling, that would be favorable to risk assets and neutral to bonds. And in an environment where you have a rise in inflation, that means that yields are going up, and for the longer duration bonds, the impact would be a lot more meaningful. So you'd see it would be, the experience there would be negative for bonds and neutral for equities. And then the other scenario would be fiscal stress. So in this particular case, you'd see the term premium, that additional risk premium that investors demand when they go out of the curve, the term premium going up, meaning that higher yields, lower bond prices, again, impacting harder the longer maturities, and of course a variable impact on equities. So what we are seeing today, or rather what has really driven the decline of the US dollar, mostly in 2025, early part of this year, there was some strengthening last week, has really been primarily the trade policies, these administrations' trade policies. There are other reasons. Well, there are concerns with the budget deficits in the US or the Fed independence, but primarily it has really been the trade policies. The rest of the world really deeming it that it's becoming more expensive to do business with the US. And on these charts to your right, what we are showing here is that when you look at the fiscal policy, for example, a lack of fiscal constraints, really, there hasn't been a strong relationship on how the dollar has behaved when you look at that top chart. And when you even look at 2025 and you just look at the year, we had a year where the Fed was cutting rates, the S&P, the dollar weakened, but the S&P still did well. That's the bottom chart. So what we did was stress test your portfolio and see how it would perform in case of a 20% decline in the US dollar. And to your right, the total portfolio, and this is hypothetical, so the total portfolio would go down by about 2%. And when you look at the bottom, you can see the funds that would get most impacted. That would be your core fixed income, and of course, the domestic assets, particularly your small cap funds that have a lot more of domestic exposure from the perspective of revenue generation. The S&P 500 does have some global companies that do derive revenue from outside the US, not as negatively impacted, but still negative. So domestic assets and core fixed income, given the duration there, but your non-US assets would clearly benefit like we've seen today. And a key takeaway also for this slide is really the importance of diversification. Really, we can't tell about the unknowns and invest for those. So being diversified really helps, like you can see with your results for 2025. And you do have very strong diversification in your portfolio, 3 layers from an asset allocation perspective, across different asset classes, the way we are implementing those asset classes through different funds. And also within those funds, we are utilizing multiple managers with each unique skill sets. So very strong diversification in the portfolio, and the portfolio is implemented and the asset allocation designed to weather a variety of market cycles and deliver consistent returns. So in up markets, the goal is to participate as much as possible. In downturn market, have a lower downside capture. Any questions?
Any questions from the board? Okay, thank you, Florence.
I have a question. Are you recommending that we adjust?
No, I'm not. So this was a question.
This is a hypothetical.
This is hypothetical. So yeah, so there was a question that came from the group.
Okay, I missed the last meeting, so,
Well, I asked Florence to include this
Great,
in
thank
our
you.
presentation.
but
And so what this does is, and we'll do this portfolio stress tests
Yeah.
for different scenarios. We could do one for the equity markets correcting significantly. How would that, how would your portfolio get impacted for this particular case? Because really, if there was a strong decline of the US dollar, and we just try to hypothetically provide that analysis to show you what would most impacted and the total experience, which is about just another 3%.
I understand that it's all hypothetical. Does SEI have any concerns about a continued loss of value for the dollar, decline in value for the dollar?
So we don't have, what we can say from an outlook perspective, we still believe that there's room for the dollar to decline. We have a very positive view for risk assets in general, and we like the non-US there's value there. So again, not one unique view or position about the dollar. For us, what's very important is to really have that diversification in the portfolio.
And you think we have enough of the non-US assets in our portfolio
At this
currently?
point, yes. Yeah, we do have a good exposure to non-US
Okay.
across equity and fixed income.
Thank you. That's it.
Any other questions? Okay. Well, Florence, you're welcome to stay for the rest of the meeting, but if you have things to do, you may depart.
Yeah, I'll stay just a little bit and then be back if I have another meeting.
Okay. We have a fairly long one today here. So Jim, it's over to you. We're going to talk about the valuation report that starts on page 84 of the commission or the packet here. So.
Thank you, Mr. Chair. I was going to skip over an overview and then I realized we have two new board members here. So I'm going to spend a little time on starting on page C1, PDF 128. So just to give a little background context, probably 5 minutes on this tops, but why are we here? We're here for the retirees of the St. Joe Boys Retirement System. We're here to fund and pay those benefits. That's top line we have on C1, benefits promises made which must be paid for. So as we go through this valuation is as of June 30, 2025. It will not incorporate the most recent data that Florence just went through, and she gave a fund status as of December 31 on an market basis. But each year we measure valuation as of June 30, 2025. And in the middle, you'll see another highlighted comment about we're looking to establish and receive contributions that expressed as percents of active member payroll stayed relatively level. And that's true if we don't have a change in assumptions, if we don't have change in the population, if we don't have change in benefits. That's what we see in this report as well. The last bulleted item on the bottom is the accumulation of investment assets is a byproduct of this level percent of payroll contribution, not the objective. So certainly, I'll talk on the next page about the really key role investment income plays, but it's really, it kind of came by the wayside as we've set aside this contribution for all these years. The next page has the main equation you need to know as a mathematician. It's letters, so it's not numbers. The benefits are equal to your contributions plus your investment income minus your expenses. The expenses are really minor, very, very minor components. So you really get focused on the interplay between contributions and investment income. And why are you doing this? Why do you hire Florence? Why do you hire me? Why do you have lawyers? Why do you have, all these folks that are involved, auditors in this plan? It's really to get to the point where the bulk of the benefits are paid by that investment. We're not looking to, as the diagram on the right shows, page C3, we're not doing pay-as-you-go contributions. That's Social Security. You pay in what goes out every year, and that is not what we're trying to do here. We're trying to get this level contribution amount. And as shown in the diagram, you can see the upper half of what's expected to be paid in benefits is paid for by investment income. I'd say we'd want to be north of half. We'd want to be 2/3 of the benefits ultimately being paid by investment income, not by contributions. And then my last wrap up initial, I guess it's going to take me 2 minutes to do this, page C4, just to give you a sense for, we got this valuation. So starting the second paragraph, the actual evaluation is where we mathematically combine item A, your covered person data as of that valuation date, June 30, 2025, asset data as of June 30, 2025, assumptions about future financial experience and risk areas, about demographic experience, how people are going to leave employment, that kind of stuff. We did an experience study a couple years ago, so you guys have a couple years as new board members till you have that joy again, but we'll review those assumptions again. The funding method for employer contributions, we use what's called entry age normal. You'll hear that in 99.9% of public sector plans. So we combine it all, and we ultimately come down to item F. What's the planned financial position for this funded status in this valuation report and the new employer contribution rate? So that was even quicker. I think that was 1 minute. But, so now if we go to page A2, which is where I plan to start on PDF 91, we'll drive straight to the results. Once you get there, you'll see a landscape page, which are detailing the contributions for the fiscal year ending June 30, 2027. So beginning July of this year, ending hence. And I won't comment, there's 1, 2, 3, 4, 5, 6, 7, 8 different groups. I'll comment on a couple of the groups as I see fit, generally work from the total. But as we said at the start, we've got this level contribution as a percent of payroll going on. And then you see fire, and they're all dollars. Well, that's because fire is closed to new hires. There will be no new active members there. This top half of this chart relates to what's called normal cost. That's cost for benefits accruing during the year for active members. Fire has 0 active members, so they have 0 normal cost. The rest of the groups, these normal costs, all normal costs relative, whether we're talking about total normal cost, the end of that first set of numbers, net of member contributions, the employer normal cost, those all remain level except for, I think it was housing. Housing, if you compared last year to this year, that 15.3% of payroll was 12.55%. That's not level at all. Well, we had 2 housing people last year, 2 housing actives. This year we have 1. So at anytime you have such a huge change population, you could see a change in the normal cost piece. Moving down to the amortization amounts, this is amortization of unfunded accrued liability, which we'll cover on the next page. What does this mean? This means we've got liabilities that have accrued to date that we want to fund. We measure versus the assets we have to date. That gets us an unfunded or overfunded liability. And this is the amortization amount of this, like a home mortgage. We'll talk a little bit more because it's different from a home mortgage, as we'll see. But we're basically making a payment on that unfunded amount. The results stayed level for general, police patrol, police command, Wastewater went up a little bit. Housing went way down, but again, that's payroll got cut in half. So we're talking about an amortization amount on a payroll that's half as big. We also saw that Public Works Union went down quite a bit, 4.22% to 1.72% this year. And really reflecting within that group of 28 people as of June 30, 2025, we had 5 new folks. We had a terminated vested person. We had another terminated non-vested. We had some transfers in and outs. There's a lot of movement in that group as well, which served to impact those results. The big picture, estimated dollar contribution way to the right, 2.111446, 2,111,000 is roughly in line with last year's number. So while I'll talk about the experience being that we had larger pay increases than expected this year in this valuation, that was offset by asset returns, which were better than expected, which we'll talk about, and by demographic gains related to more retiree deaths and people who terminated non-vested. They left without a vested benefit. Any questions on this first page? This is the contribution for the 2027 fiscal year ending.
Where are you seeing the comparison to last year? Is that a
Yeah.
separate chart?
I love it. It's in last year's report that I compared to.
That's
Emily, I like to give the board.
always
sense
thinking.
of how things move. But since you ask, there is another place where you can see a comparative chart, which I wasn't planning to review, but on page A6, you'll see the contribution amounts year by year. And so that at least gives you the percent of payroll from last year's valuation, the 2024 valuation, to this one, which is bolded in black at the bottom.
Thank you.
But going forward, I will reference last year's valuation again, just to give a sense, and you can tell me if it's helpful or not.
Thanks.
Sure. So moving forward to A3 now, one page forward. You'll see another landscape page, present value, future benefits, and accrued liabilities. So what's present value, future benefits? So we do millions, tens of millions of calculations for St. Joe. And the present value, future benefits is basically saying, here's our people, here's the benefits we provide, here's the assumptions, pulls it all down to ultimately one number. Here we've got them broken out a bit, but we can get you a number for the entire plan, the present value, future benefits promised to all people as of this valuation date. So we're projecting liabilities forward, we're bringing them back with our interest rate, that kind of stuff. And this gives you a sense of where they are. Now, the first item A1 is the accrued liability for retirees and beneficiaries. And this increased for all groups except for housing and wastewater, and increased pretty largely for police, patrol, and command. Last year, a number that you can't see is the $61 million was the liability last year. We're at 66.5 this year. We expect this number to continue to increase as we go forward. We've got a separate number for vested termination members. Vested terminated, what does this mean? This means people who worked at St. Joe long enough to accrue a vested benefit, and now left employment here, they're somewhere else. But at some later date, they can come back and get a benefit from the retirement system. That's a relatively small number, $1.387 million. Not much change relative to last year. For present active members, item 3C is the liability for this group. And following off to the right, we've had a decrease in that number from 25 million to 22.2 million. In part, that's because we had liabilities for one remaining active firefighter last year that's no longer there. So you see dashes for the fire group. In total, our total accrued liability has bounced up $3 million to $90 million at this point. We like to compare it to our funding value of assets. I'll cover this. We don't use market value for funding the plan. We use funding value, smooth the assets experience over a 5-year period. This number went up to 81 million, so it went up a little bit more than the increase in the accrued liability. As a result, we've got an unfunded accrued liability of $9 million, which was 9.5 million last year. Florence referenced a 95% funded ratio as of December 31, 2025 on a market value basis. Well, at June 30, 2025, which is the basis for the contribution, we're at 90% funded relative to 89% from last year. And you can see the market value basis is above that. We've had gains and gains and gains, which I'll talk about, which is we're ultimately trending up toward that market value number as we go forward. The next page is then taking this unfunded accrued liability of $9 million and saying, okay, how does that get into that contribution I talked about on the first page results? So we've got what's called layered amortization. And my goodness, I talked to the board 3 or 4 years, 5 years ago about this. We finally see it in action. So it was adopted with the 2024 valuation. And so we could see 2 layers here. We didn't go through those detail last year because 2024 was the first year. But for the base year 2024 says we've got, at the top, we've got level percent of payroll for all groups except for fire. Fire is down below a level dollar. But stay in the top chart. The base year 2024, that's a fiscal year 2024 plan experience. It's all experience up until 2024. So that's always going to be the largest number, barring some wild swing in the markets, either up or down. So without going through all of it, you see the unfunded accrued liability base for each and every group. Going to the right, it's financed over 14-year periods, that top line for the 2024 experience. We got an amortization factor. And then we show the 2025 experience. So what happened with each group just for that year's plan experience? There's gains and losses here, which we expect, but really, really small numbers. So you'll see in both these, all these charts, the 24 is the driver, if you will. And ultimately, we're paying down that bigger number over 14 years. That financing period, 14 years, is going to go all the way to 1. And then it's going to disappear. We'll have paid it off. Versus in the past, some longer-term board members know we used to reset amortization periods, never really have the joy of seeing it being paid off. So that's what's going to happen. And we'll keep adding layers as we go forward. So that was the base in the top. And the middle part is really showing how the payments derived. So those payments will match back to the contributions I showed on page A2. And then similarly for fires down below, this is on a level dollar basis. Again, for new board members, level percent of pay means we calculate our contributions as a level percent of payroll. We expect that payroll to increase with wage inflation going forward. So these amortization payments are level percent, calculated as level percents of payroll, but that's going to be on increasing payroll. So we actually have an increasing payroll stream as we go forward for that. Whereas level dollar is what it says. We expect this level dollar to be level. We're going to see 2024 be level for the next 14 years, this 2025 piece be level in terms of a dollar amount. So again, these all feed back into the contribution rates on the first page. I'll pause because I've presented this to a lot of groups, and at one statewide client, they said, "Oh my God, why are you talking to me about all this detail?" But this is what we're doing with the amortization of payment of the unfunded.
No, it's good to see the layer because we have talked about that for quite some time. And it was always, when do you reset it? Why do you reset it? And this way you just pay it off each year, and it just makes more sense to me.
Yeah, and I would agree too, and this board's always been very prudent as well. In terms of, in the old days, they'd reset the amortization period to 25, 30 years. Well, do we really want to do that? We're in a good financing position. Let's keep funding the plan, keep the plan right around 100%. And having a shorter amortization period keeps you kind of closer to that bound as you go forward. All right, now to the next page, page A5, the funding value of retirement system assets. So you'll see item A is funding value, item B is market value. We are part of getting that level contribution is smoothing these assets. That's basically what we're doing here. I would start this chart at the end, item J, the market rate of return. See 13.58% for 2025, 11.62 for 2024. And just for Emily, in 2023 it was 9.5 and 2022 was 11.2. But I wanted to highlight those because you can see that negative amount, the 2.7 million in item F4, that's from our 22 experience. So we've had 3 good years. We had a horrible year the year before that. Everybody did in 2022. And there was a great year in 2021. So we've got 13.58%, as I said, in item J under column 25. If you go up to item E1, that's our market total, $10.3 million worth of return. Our assumed rate is 6.75%. We recognize instantly that 6.75%. So our bogey is really 6.75%. When we get 13.5%, we're exceeding our rate by 6.75% or so. Or let's say I can't do the math in my head. That might be right. Yeah. So we're halfway there, and you can see that between what we say. So we say we immediately recognize that amount we expected, 6.75, and we also then phase in the remaining half, the $5.2 million. If you divide the 5.2 by 5, you should get 104,247. That becomes part of this year, and then going down the right, down the diagonal, the successive years as well. Staying in 2025, if we add up the results from this year, the million, 600,000 prior year, et cetera, we get an item F6, $1.4 million. That's our gain this year from assets. Going forward, we expect, if we earn our 6.75% each year, $773,000 loss next year, followed by a 1.988 gain, blah, blah, blah. Relatively small numbers here for those who have seen the bigger numbers from like 2008, that kind of. So it gives you a sense where we're going to go. So this valuation is where it is. Next year, we'd expect a slight reduction in funded status if everything came true the way we expected. Slight increase in contribution rates, but nothing really harrowing as we go forward. Any questions at this point? Because I'm just going to do a wrap up for, it's going to be 10 seconds after this.
Is it always me with the questions? So we're taking, just doing the math on my calculator. We're taking E3, we're dividing it by 5 and we're allocating it across this year and the next 4 years.
E4, yep, E4.
E4.
Yep, divided by 5.
E4 divided by 5. But then E3 is what we expected and
Yep.
E4 is what we bonus.
So it's basically, we had a total of 10 million, we expected the 5.1, and so we fully account for that this year. And then the rest we smooth over the 5 years. So the 5.2 is what's spread. So yeah, basically, another way of putting it is, you know, our bogey is the 6.75%. If we earn 0, we would have missed the mark by 6.75% and we'd have, well, I don't even know if I want to.
Let's not go there.
Yeah, yeah.
But we're saying we expected 6.75%. We got it. We're applying it this year. Everything else is gravy. We'll divide it up over 5 years.
Correct.
Okay, thank you.
Yep.
I gotta say it out loud. I just
No, that's good. That's
gotta make
good.
sure I got it.
That's why, was it Yusuf? What's his name? One of the things he said, yeah, you can take all the risk you want because you can smooth it, you know?
Yeah.
And you thought, nope.
Exactly.
If I know Tim Zebel at all, that didn't land well.
No, I'm not a risk taker, so I think everyone's figured that out by now, so.
Yeah, exactly. Okay, well, I'm gonna go to A14 for a wrap up then. Another page I don't usually cover, but I thought, why not? So comment G is talking about basically what we're here doing, trying to talk about our allocation, contribution allocation procedure, funding policy, et cetera. So we expect that if we earn all our assumptions, if we hit everything, including 6.75% in assets, the employer normal cost amounts as a percent of payroll will remain relatively level, except for those really tiny groups, or if somebody sneezes, et cetera, whatever else it changes. The unfunded accrued liability will be fully amortized over 15 years. So that's that 2025 piece. 2024 piece will be amortized over 14 years. So, you know, it's a generally true statement, will be amortized over 15. And we'll be trending towards that 100% funded ratio as we go forward. My concluding comments are the retirement system continues to operate excellently. You folks who have joined the board or are joining a group that I don't talk about it by name, but there's other plans around the country that say there are plans that are 90, 100% funded. I say, yeah, they are. And, you know, why are plans 100, 90, 100% funded? Because you're funding the promises made, which is a problem we have in Chicago, for example. They don't fund it. And you keep the assumptions up to date. You don't take crazy risks, but you invest the plan prudently and manage it. And so I think we're in great shape and we're on a great set of assumptions. And I welcome any other questions.
Any questions for Jim? It's a lot to take in, but should wait till board member comment, but I'll just make a pitch for going to the MAPERS conferences and attending the Sunday afternoon sessions, because the first hour is the actuary hour. You'll learn more and more about this. And then the second several hours are attorneys telling you all the things that will scare you about being on the pension board, but it's very educational. So
Let the record show I love actuary hour.
That's great. And, you know, I can't stress that enough as well, because I meet with boards all the time and I feel for you all, because like you come in, you hop on this board, you hear a bunch of things. And hopefully I didn't use any acronym. I might have used the acronym, but it's hard to digest right away. And so the other part about Love MAPERS is I see all you guys, and usually there's a discussion, a sidebar about something with the plan, which is great. But also available for any education.
But never in a quorum.
Never in a quorum, that's right. But we're certainly available for educational as well. If I need an excuse to come down here and be at the beach, let me know. Or Zoom, whatever, so.
okay.
Thank you.
Questions?
I think we're in good shape, so
Yep, exactly.
That's the goal.
Okay, so now we're going to move on to Fund 731 financial reports. That's on page 153 of the packet.
153. So we have a new system, so I have updated the report slightly. Before it was as two separate reports, now it's one combined report. We have both the balance sheet and the revenue expense all in one place. Attached is the report for review. Total net assets of December 24 were 80.36 million. This year, they were 90.1 for an increase of 9.7. Total net of revenues and expenditures for December 24 were a surplus of 2.67. This year, we're showing a surplus of 5.1. Attached is report for your review.
Ben, do you need any action on this?
Nope.
Yeah, it's just received the report. Any questions for Ben on the financial reports? Okay, if not, we will move on to,
What's a good one? 157.
yep, the IRS Form 945 penalty update.
Yep, so we've been working for quite a while with the IRS about penalties on our 945 forms. The update we're going to share today is we received our money back from tax years 22, 23, and 24. But I am not super excited because I don't know if that's going to solve the problem or not. So we'll find out for tax year 25. But we have received money back for the past 3 years. I want to temper expectations as we're still trying to work through the issue.
We
Well, that's
haven't,
great news because I didn't think we expected that, did we?
I always
It was
expect
very
that.
iffy. Yeah, it was very time consuming and frustrating to work through these issues with the IRS.
The IRS never.
Yeah, well, you would think as a local municipality, they have a little bit of, I don't know, they'd work better with us, I guess, but, we ended up getting Heisenka's office involved, to try and get a taxpayer advocate. I can't tell you how much time Ben and I spent trying to work through this. And the reason he's a little unsure of what it's gonna be for 2025 is we got all the money back, which to me says, yes, they understand that somebody made a mistake there. There was some error with their interpretation of how we were making our payments. But we haven't received confirmation that, yes, that is why you got all your money back. So Ben's a little bit concerned about continuing as we have been. And just to back up a little bit, the tax withholding has been paid to the IRS at the same time payments are made to retirees. So it's once a month. They were saying the IRS believe that we need to make payments twice a month, which would mean that one payment would be made before the retirees receive anything. So we'd have to estimate what that would be. It didn't make sense at all when you look at the IRS code and their materials that tell you how to interpret the code. It basically said what we were doing was the way to do it. So we're not really sure why that even happened in the first place. So we're trying to nail that down and get confirmation.
Yeah, we're not done.
Yeah, for 25. So we're really glad that it turned out the way it did. It's just you never really know what you're going to get, and we want to have some assurance before we end up spending lots of frustration, time, and effort to do this. So it's good news, but we're not 100% sure for 25 how the best way to proceed is.
Okay.
Yeah.
Well,
Thank you both for working on that.
Unfortunately, more to come probably.
More to come. Yeah.
Yep. All right, moving on to update or change in beneficiaries.
Yep, so we just have one this time. Michael Holliker passed away. His obituary is attached.
And he was Street Life 10 years, so this looks like his wife contacted us and
Yeah, I need to defer to Sam on the details of that.
Yeah, we had a 10-year certain and everything was paid out.
Do you need any action?
No.
Okay.
okay, then we'll move on to the financial reports on agenda page 164. These are required by the Government Accounting Services Board,
The Government Accounting Standards Board.
Standards Board,
Yep.
there we go. And we do not plan on covering these in detail.
Nope, I'm just including them for your information. We've published them so you can view them anytime. We have the 75, which is the pension OPEB, the 67, 68, which is the pension plan itself, and then those are used to generate the annual financial report, which is also attached, and that is used to generate the city's financial report.
Any more questions for Ben? Or Jim on that,
Yeah.
since they prepared a lot of them. Okay, if not, then we're gonna move things along to subcommittee update and old business on page 288. And Ben, I don't know if you're doing this or if Lori's doing this.
Probably both. Laura, do you want to grab a mic?
All right, is this on?
Yep.
Okay. Right, basically what we have here is a list of what we have in place currently, that's on page 289. The policies that 1 through 9 have been adopted already. Some of those will show dates of amendments. We also have several forms that we have as part of the plan. All of these items are actually available on the website. If you type in pension, it will pop up, including the calculator for the pension calculator for public and non-public safety employees. So that was something that we added not too terribly long ago, which I think is really helpful for people as they're trying to figure out what they might plan for their retirement. We still have several policies that we would like to adopt. Kind of a general due diligence policy. Part of what you saw with the report on who had passed away with the pension plan is to try and keep the pension board members updated on changes along the way. There are a lot of due diligence things that we need to look at, and it may be confirmation of I don't want to say the word that we don't want to say,
Yeah.
but help me out, Sam.
Confirmation of life, I think is
Yeah,
our.
yeah. Verification. that
Oh,
would-
thank
yes,
you,
yes.
Lori. I know what you're doing.
Yes, so we want to make sure that the people who are getting paid are still supposed to be getting paid, things like that. So that's one of the recommended policies. Domestic relations order, again, it's not something that comes up a lot, but we do have situations coming up where we need those and we have to work through those. And we don't have a policy in place with the pension, which would be helpful for those that need it. An election procedure, we do have a process that's followed. Abby, the clerk's office has a process, but we don't have an official policy incorporating that procedure. So that would just be cleaning up. Freedom of Information Act, state law does govern what's required to be provided, and the pension board has always basically fallen under the provisions of the city's policy, but it is a separate board, so we really need to have a separate FOIA policy adopted by the board. And that would be basically my recommendation on that would be just incorporating what we do for the city and probably delegating that to the clerk. But again, adopting that for the board, and similar for a record retention policy. State law governs all of that, but we should have an official policy adopted. We did lose, actually, I'm trying to think, we have a subcommittee, which right now it's Bob Judd, Sam, and I are on it. We would look for one other member. Adam had been on it before, and that helped us kind of work through things and then present those changes, proposed changes and policies to the board. Also, what we would like today is to have the board weigh in on what you would want to see as far as priorities. If there are other policies that you think we need to look at. Of these 5, I starred the 3 that would be, in my mind, kind of low-hanging fruit. Get those implemented, and maybe work on the others as we go. So, nope, two things. One, a volunteer, and two, just priorities.
I think if I volunteer, I get to have these priorities, so I'm gonna just volunteer.
Love it.
Works.
I do
Thank
too,
you.
because I semi-volunteered the last time, but you could see it in the notes. It was reluctant and only if you needed me, so.
That was wholehearted. I don't know if it's needed, but I second Michael's volunteering.
I saw
Do we-
direct deposit authorization form and I just got accepted.
Right, as one does, totally normal.
Do we need a motion on that, Lori, or we just?
No, I think it's
Okay.
just volunteering. If
I do have,
volunteer, then we'd probably have to do that.
I do have a question at the trustee development series thing.
Yes.
They go through that one, your administration. Does this include all the policies that they have recommended in that? No.
No, it doesn't. The ones that we have adopted are definitely high priority with that. The ones on the recommended list are also included there. There are some others that I didn't put on this priority list. So I chose the ones to put on for today. There are more, but I think these are definitely rising to the top of the list.
Okay,
If I remember correctly, I think Tom Michaud gave us a suggested, or a recommended required list, and we have hit the ones that are required. Unless I'm,
Yeah, I mean, yes, but some of those are the start ones as well.
yes.
Yeah.
including
so
the
we have a list that are recommended and we have a list that's required. I remember I asked him during
Yes.
one of those
Yes.
sessions and the guy said, good question, next question, like he didn't want to answer it. So,
They're all required.
Well,
Yeah.
yeah, I mean, again, the starred ones are the number 4 and 5, the FOIA and record retention are required, and we follow state law, so I feel good about that, but we really
Mhm.
do need to have our policy in
Yeah.
place. And the election procedure, again, we have a process, but we really need to have a policy as well.
investment policy statement is a very, I think that is absolutely required
Yeah,
and an important one to have. We're in good shape there, so.
Yeah, the actuarial funding policy, another one,
Yep.
so.
Any other questions on that? Thank you, Michael, for volunteering. Moving on, we have the, under new business, fiscal year 27 funding recommendation. That's page 290.
Okay, so we just saw Jim presented the evaluation, and we're using that chart that Jim was talking about to form our employer contribution rates for next year. So on page 291, I have the spreadsheet we use, which is in accordance with our policy, which is attached after that. We are asking for approval of the rates for next year. Everyone will be a percentage except for fire. Fire will be the dollar amount. And the rates are in the row that's called FY27 funding rate. And those will match the table from the valuation except for housing. And housing, per our policy, we use the bottom row there where it says greater than 150% funded. The 3.83% is the calculation per our policy. So we don't contribute zero, we contribute something. And that is the math and how it works out.
Just to be consistent with my previous question, how does this compare to last year?
Same answer that Jim had, they'll be on last year's valuation. They're slightly higher, or maybe not so much higher.
Really, really close.
Real close, yeah.
That 2 million, 2.2 million. It's within.
Yeah.
Yeah.
Okay, thank you. Anything, Ben, that you see as concerning?
No, nope, this is straight out of our policy, exactly what we've done in the past.
I'll move to approve the City of St. Joseph Employees Retirement System fiscal year 27 employer contribution rate as presented.
Okay, moved by Emily, supported by Michael. Any other discussion? All in favor, say aye.
Aye.
Aye. All opposed, motion carries. Moving on to 6B, the 731 invoices paid, page 298.
Okay, attached is the invoice list as usual, and I want to point out that because of the change in accounting system, there are some invoices that we have not seen in the past, but we are seeing now. Also, because we are setting up our system to calculate the employer benefits for us, that also contribute or followed into the pension side, which is adding to these. So there are payments to state, withholdings, those are all now being presented where in the past they were not. So total of payroll transactions was 180,248.11. Total of retirement system, 21,255.32. General government department was 12,459.22 for a total approved of 213,962.65.
And there's detail on the following page, right?
Yep, the report is attached.
So we are looking for a motion to approve to pay the invoices.
I move to approve the payment of invoices paid from the retirement system fund in the amount of $213,962.65.
Support. Okay, moved and supported. Any other discussion? All in favor, say aye.
Aye.
All opposed, motion carries. Any public comment?
Any public?
Any trustee comment? I'm gonna talk about MAPERS again. It's really important to get educated on this. They put on awesome training. The spring registration is out. It's in Bay City. I think it's in the middle of May. And I strongly encourage everyone to attend.
And I'll just add to that for anyone who does want to attend, Tiffany is happy to handle the registration. So if helpful, I can get an email out to the board and other interested parties to get that conversation rolling. She'd be happy to take care of things.
Yeah, and I will echo what Tim says, and I usually won't echo things, but it's really, I don't like anything on a Sunday. But going to MAPERS on a Sunday is something really, really important. And I will give up my Sunday to do that because it's so informative. So I don't let that stop you. You know, it's hard on a weekend, traveling that way, but it's well worth it. And I think that helps give you a foundation, especially it's good for a refresher and it's good for new information. So.
Is that 15th or 17th weekend?
Sounds correct. Yep.
That is right. And it will look, when you see the email, it will look like it starts on Saturday, but it doesn't.
It's a Sunday.
I mean, the action's on Sunday. I think you can arrive on Saturday and go to some sort of soiree. I would discourage that. But I believe it is like Sunday early through end of day Monday or even Tuesday early.
Midday Tuesday.
Midday Tuesday.
They usually
I
are
usually cut out early.
afternoons of Sundays, except the last one.
Oh, that's right.
First time ever, they did it in the morning because the Detroit game was on and everybody. wanted to see the
Yes.
Detroit.
It starts at like noon on Sunday and it goes all day Monday and then there's like Tuesday morning.
I'll do some schedule coordinating.
Okay, cool. But yes, it is that weekend. That's right.
And there is a MAPERS achievement program where you can essentially, there's 3 levels of it. For the new people, again, I strongly encourage you to participate in that. You're not even allowed to take the test. Well, you can, but only practice. You have to get some sessions under your belt before they'll officially allow you to take the test as you move up the different levels. But it's very good. It reinforces what you've learned and I encourage, again, participation in that. So, and they do have sample tests, the first one actually is a little easier because you can go in and kind of get an idea of what the questions will be, but they do get progressively harder as you go along. I will say that.
Yeah, the website's really helpful too. You might have to dig a little bit because of the way they organize some of the program materials, but if you can look at that before you go, that's also helpful. It may help you understand the materials a little bit more and gives you just some good overview. The trustee seminar or trustee development
presentation's a really good one to start with.
Yep. Any other board comments? Okay, motion to adjourn,
So moved.
supported by,
Sure.
okay,
Who was
Hey,
supporting?
There's the passion we're looking for.
all in favor, say aye.
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 Okay, meeting is adjourned. And I think we're sticking around to do OPEB
Yeah, so
for,
if.
I'm gonna leave.
Yep, I just need enough of the pension board to leave, so we're gonna have a quorum. Otherwise, feel free to stay, and Jim's gonna go over the OPEB with us.
do you want this recorded? I was gonna end. the
You can
Zoom
leave,
meeting.
yes.
I think, Philip,
Okay,
Phil's been very patient.
Hopefully he's out
he's here.
there. All dressed up.
Would you like your tree back?
I don't need it. No, I've got my own right here.
Emily, great to see you.
Actually,
Appreciate the questions.
if you didn't mark it up, I'll take it to Public Works if you don't want
Just
it.
say basic.
Good city, yep.
I've never been.
And we're-
Don't worry
we're
about that.
sponsored
Yeah,
the
I'll take it
Shark,
down there.
so
That way we're not burning another one for them.
Instead of a mechanical bull. it's a mechanical shark.
No way.
Have you done that before?
Yes.
No, but I would love to watch other
That's
people
not
do
something
it.
I'm gonna do for the first time.
Ben,
Yeah.
Exactly.
But I'll watch other people do it.
Yeah.
Ben, I'm gonna ask you, do you want this recorded? I don't.
I don't
see
think we need it
okay,
recorded, no.
great, Let
Special
me
things
stop
before you do
that.
that.
Oh, yeah.
Thank you.